what y'all are seeing. So we're gonna go do our best getting started here. So welcome to the ghost of the TCJA session. We likely won't be as entertaining as David and Helene were, but we'll do our best to give you some good information with this session. So a few reminders. You will need to stay logged in for the entire session and submit the feedback survey with the attendant code words to receive CPE. Please mute your mics and feel free to use the chat for any questions you have. We will try to address them during our presentation, but we'll have time at the end, hopefully, to review your questions. I will begin this session reviewing qualified opportunity zones. Then Josh will go over the qualified business income deduction updates, and I will end with the updates on the business interest expense limitation. So opportunity zone regulations were enacted in the 2017 Tax Act. Sections 1400Z1 and 2 were added to the code and provide significant tax incentives for investment in qualified opportunity zones. Qualified opportunity zones are designated low-income communities in each state and territory of the United States. The goal was to spur long-term investment in these low-income areas and to generate opportunities for startups and new businesses. According to the White House Council of Economic Advisors reports, $75 billion was invested at the end of 2019. An estimated $52 billion, 70% of the total, is new investment that would not have occurred without this incentive. It is estimated that OZ investments have created at least 500,000 new jobs in designated opportunity zone tracts. Here's the map of Virginia, and the blue highlights are the designated opportunity zones. There are 212 opportunity zones throughout the state. And here locally in Charlottesville, we have 4 tracts. I'll go through just the basics concepts today and some recent changes as the rules get rather complicated. Any taxpayer that realizes eligible gain with an unrelated person may elect to defer that gain under the Qualified Opportunity Zone regulations. These taxpayers include individuals, C corporations, partnerships, S corps, and trust and estates. Partnerships or S corporations realizing eligible gain have a choice to either elect to defer that gain at the entity level or to pass the gain through to its owners, who are then free to make their own decision on deferral. Eligible gain is all capital gains invested in a qualified opportunity fund within 180 days of the date of a sale or exchange, or the date gain must be recognized. Both short-term and long-term capital gains qualify, as does unrecaptured Section 1250 gain. Any portion of 1245 or 1250 gain that has to be recharacterized as ordinary income is not eligible gain. Section 1231 gains and installment sales also qualify. The proposed regulations originally said a taxpayer whose Section 1231 gains for any taxable year exceeding their Section 1231 losses for that year could make an election to defer some or all of this net capital gain. The final regulations provided on December 19th of 2019 changed this so that a taxpayer could immediately contribute Section 1231 gain to a qualified opportunity fund, even if the taxpayer has other 1231 losses later on in the year that normally would reduce the net 1231 gain. This was a win-win for taxpayers. They could defer 1231 gain, which would leave a net 1231 loss that would give rise to an ordinary deduction. And if they made the investment in 2019 or 2020, when the gain gets triggered in 2026, the 1231 losses from those years would be outside the 5-year recapture window. Now, related to installment sales, the final regulations clarified that if a taxpayer sells an asset on the installment method and that gives rise to eligible gain, the taxpayer may defer each and every gain recognized over the period of years payments are received until the end of 2026. even if initial sale was prior to 2018. Also, the 180-day reinvestment period can be either a separate 180-day period for each payment received by the taxpayer, or it can be a single reinvestment period beginning on the last day of the tax year. Gains coming through from pass-through entities have several different ways to determine the 180-day period. A shareholder or partner can use the date of sale inside partnerships or S-corps or the last day of the tax year as the beginning of their 180-day period. The final regulations added additional flexibility and provides that the taxpayer may elect to start the 180-day period on the due date of the pass-through entity's tax return, not including extensions. So if you had capital gains coming through a partnership on your 2019 K1, you would have had until September 11th, 2020 to decide to defer the gain and make an investment in a QOF. So just as everything else this year changed due to COVID-19, there were some 2020 updates and automatic relief provisions passed that helped taxpayers who plan to invest in QOFs. Notice 2020-23 extended the 180-day period to invest eligible gains to July 15th for any investment where the requirement would have occurred on or after April 1st, but before July 15th. Notice 2020-39 later increased the extension for the 180-day period to December 31st, 2020. It also provides penalty relief if the QOF failed to meet its 90% investment standard during the April 1st and 12/31 period. We'll go over this test a little later. Related to the 30-month substantial improvement test period for QOFs, it provided that the period of time between April 1st and December 31st would be disregarded in that calculation. The notice also provided a 24-month extension to expend working capital assets of a qualified opportunity zone business and a 12-month reinvestment period. So let's review some of the basics and the benefits of QOZ regulations. First, qualified opportunity zone investments provide the opportunity to defer gain through December 31st, 2026. If there is an event or sale before that date, gain may be required to be recognized sooner. Second, QOZ investments are eligible for permanent tax reduction. For investments held for 5 years, the basis in the investment is increased by an amount equal to 10% of the gain deferred. Investments held for 7 years will receive an additional 5% increase. So the total potential increase is 15% in basis if the QOF investment is held for the full 7 years before December 31st, 2026, when gain deferral is required to be recognized. Now, the biggest potential benefit, though, is the opportunity for non-taxable future appreciation. If the QOF investment was made in conjunction with a proper deferral election and held at least 10 years, the basis of such property shall be equal to the fair market value on the date the investment is sold or exchanged. So, for example, if you invested $1 million in eligible gain in a QOF by December 31st, 2019, you would receive a full step up in basis and recognize only $850,000 of the deferred gain on your 2026 tax return. If you then sold your interest in the QOF in 2031 when it's worth $2 million, the $1 million in additional appreciation is completely non-taxable since it was held for more than 10 years. The final regulations clarified this would apply to recapture as well, since the step up is to the full fair market value. You are able to make multiple investments also in a QOF. However, any investment above the eligible gain would be treated as separate investments. Gain exclusion provisions only apply to the investment of eligible gains. A taxpayer must affirmatively elect to defer eligible gain on Form 8949 with their federal tax return. You will report the total gain received during the year. Then on a separate line, you back out any eligible gain you wish to defer in the qualifying investment. Depending on whether the gain being deferred is short-term or long-term, you will check the boxes in the appropriate section. You will also have to enter the EIN of the Qualified Opportunity Fund investment and provide the date it was invested. If you make multiple investments, you would just do that on a separate row. Now, our first attendance code word is opportunity. It's opportunity. So put that in your feedback survey. There are several filing requirements for both QOF entities and QOF investors. Form 8996 is filed annually by corporations and partnerships to self-certify that it is organized to invest in qualified opportunity zone property. The form reports that the QOF meets the investment standards or to figure the penalty if it fails to meet the investment standard. Form 8996 was updated in January 2020 to better track QOF investments and to report whether the investor disposed of part or all of their equity interest in the fund, and to report qualified opportunity zone business property directly owned or leased by the taxpayer. The IRS has started to send notices to taxpayers who attached or indicated they attached Form 8996. Additionally, taxpayers may receive a notice if they may not have completed Form 8949 correctly when they reported the deferred gain. Form 8997 is filed by all investors in qualified opportunity funds and reports the total holdings in QOF investments at the beginning of the year, any current year capital gains deferred, QOF investments disposed of during the current year, and the total QOF investments held at the year end. We've had a few clients set up their own qualified opportunity fund entities rather than making an investment in QOFs in the marketplace. In order to do so, you must be a qualified entity. Qualified entities are those entities organized for investing in qualified zone property and opportunity zone trades or businesses. The organizational documents must specify the entity intends to be a QOF. Entities must be a corporation or partnership. They cannot be disregarded LLCs or entities and must be organized in the U.S. Pre-existing companies are eligible if they meet certain program requirements. There are also several disqualified entities clearly mentioned in the regulations, such as golf courses or country clubs, racetracks, gambling facilities. The QOF qualifications can be a bit complicated, but generally, a QOF must hold at least 90% of its assets in qualified opportunity zone property. The 90% investment standard is determined by the average percentage of the qualified opportunity zone property held in the QOF as measured on the last day of the first 6-month period of the tax year and the last day of the tax year of the QOF. The value used for the asset test depends on whether the QOF has applicable financial statements or not. For qualified opportunity zone businesses, there are several additional tests, such as substantially all of the tangible property owned or leased by the business must be qualified opportunity zone business property and used within the opportunity zone area. At least 50% of the total gross income of the OZ business must be derived from the active conduct of business within the opportunity zone area. If all of the QOF investment is in a qualified opportunity zone partnership or qualified opportunity zone business, the QOZB test is 70% and not 90%. If the QOF property is sold or exchanged, the QOF has 12 months to reinvest proceeds back into QOZ property to meet the 90% test. Qualified Opportunity Zone property can be stock of a domestic corporation or a partnership interest acquired after 2017, directly in exchange for cash that operates a Qualified Opportunity Zone business. QOZB business property is tangible property used in a trade or business of a Qualified Opportunity Fund if it was acquired by the QOF after December 31st, 17, and the original use of the property commenced with the QOF, or the QOF substantially improved the property, and during substantially all of the QOF's holding period, substantially all of the property was in a Qualified Opportunity Zone. Qualified Opportunity Zone business property cannot be purchased from a related party, and property that was already held by the business before December 31st, 2017 does not meet this definition, and neither does property contributed to the QOF. Commercial real estate development and renovation in opportunity zones has been the greatest area of investment to date, but we are beginning to see new business open up in opportunity zones as well as existing businesses expand into OZ areas. We imagine many more investments will continue to be made over the next 5 to 6 years to take advantage of the tax incentives and continue to build up these low-income communities. There are a lot of things that should be taken into consideration when considering the QOF investments. From a tax reporting side, not all states conform to federal tax rules, so you should factor in whether gain for federal purposes will be different than the state the business is operating in. Additional tax planning considerations are that future tax rates are unknown, and all capital gains will be taxed at the rates in effect in 2026 when the deferral period ends. There is an Opportunity Zone Extension Act in the works to try and get the date for realized OZ gains extended from 12/31/26 to December 31st, 2030. So this could really help generate more investments in the Opportunity Zone areas in the future. They are also trying to increase reporting requirements since only qualified opportunity funds are required to report that they satisfy investment standards. The separate Qualified Opportunity Zone businesses do not have any reporting requirements currently. Now, unlike Section 1031 like-kind exchange, which is only available for gains from real property sales now, the QOZ deferral is available for all gains, sales of stocks, partnership interests, etc. Any amount can be deferred. Not all the gain or proceeds is required to be invested, so there is some flexibility here. With the extended date to December 31st, 2020, there is only a little more time to make any additional investments or meet the 180-day requirement to defer gain from 2019 or for this year, depending upon when and where the gain was derived. Should you have clients with significant capital gains and they would like to consider possible deferral options, please feel free to see me or another tax partner to review the transactions to see whether a QOF investment might be a good opportunity. Now I will turn it over to Josh to review the 199A provisions, unless there are any questions.
All right, so it looks like there are no questions for Kendra, and I'm hoping that everybody can now see my screen, which should show the Section 199A deduction slide up on it. For those of you who don't know me, I'm Josh Reifel. I'm one of the tax supervisors here, and somehow I have become the subject matter expert on Code Section 199A that was part of the Tax Cuts and Jobs Act in 2017. One of the great things about this section right here is that with all the changes in the CARES Act and the various other coronavirus relief packages, nothing really changed in this. So if you've been here for the last year or two, you've been doing tax returns, hopefully by now you've gotten used to it and hopefully you figured things out. So this should be more of a review and with very little new information. So Before we get too much into it, just as a refresher, or for those of you who may be new, we will look at a couple of key terms as they're used in the code section, as well as the regulations and various reference materials. QBI, qualified business income. This would be any income from a qualified business. Schedule C, partnerships, S corps, etc. Now, one thing to note, qualified REIT dividends as well as PTP income. All right, these fall into the code section, but technically they're not considered qualified business income. Those are their own separate buckets. So just be aware of that being, apparently, oh, sorry. Apparently I was not. Okay, so now I'm sharing the wrong screen. Give me 1 second. This is not the screen that I want to share now.
Josh, we lost your screen. You want to reshare again? Hey, Josh, you dropped off or are you still in the session? Hey, Kendra, can you pick back up and see if we can get Josh back in?
Yeah, he's showing on hold or something. I'm not sure what's going on.
We'll see if we can figure it out.
One second. Can you get it, Josh?
We love technology. Go to the very top and good enough.
All right. Now, Josh, we can't hear you.
Josh, you see doing mute. Oh, you're unmuted, so you're ready to go.
I have no idea what I'm just trying to share my screen. It keeps muting me and putting me on hold.
You're good. Just keep talking.
And we see this, can you see the slides now?
Yes.
Okay. Every time I try and present the show, it switches screens and I can't get it to the right screen. So we're going to just go with this. So this right here, we're going to threshold. The threshold is the only change for 2020 with regard to the 199A deduction. The taxable income at which the wage and UBIA limitations have to be considered. That has increased this year to $326,600 for married filing joint and $166,600 for all others. The phase-in ranges, $100,000 and $50,000 remain the same. This is a very brief overview. What is the deduction? It's a 20% deduction on qualified business income, which, as I said, is partnerships, S corps, sole proprietorships, and some trusts and estates. It is subject to several limitations. The first of which would be the wage and property limitations, which I'll go into in a little bit. Additionally, there's a 20% deduction on qualified REIT dividends and PTP income. This is not subject to wage and UBIA limitations, so just know that falls under a different part of the code section. And then overall, the entire deduction is limited to 20% of taxable income less net capital gains. And the reason for that is capital gains are already taxed at a favorable rate. So if the majority of your income is coming from capital gains, the code disallows further reduction of the tax rate on those. All right, so I mentioned the wage and UBIA limitation. The wage and UBIA limitation comes into play once your taxable income or the taxable income of the taxpayer, not the entity, but the taxpayer, reaches a certain threshold. And what the limitation is, it reduces or potentially reduces the deduction, and deduction becomes either the lesser of 20% of QBI, which is the ordinary deduction under this code section, or either 50% of allocable W-2 wages or 25% of wages plus 2.5% of UBIA. So basically, if the taxpayer is over the threshold limit, you figure out the greater of these last two here, the 50% of wages or 25% of wages plus UBIA, you find the greater of that and compare that to the 20% of QBI, and the deduction then becomes the lesser of those two numbers. All right. Under the code section, taxpayers have the ability to aggregate or combine separate trades or businesses, which allows them to minimize the wage and UBIA limitation. So this is only done once you actually exceed that threshold. There's no aggregation that's done or needs to be done if the taxable income is under the threshold, because there is no limitation. There are a couple of requirements for this aggregation election. One is that the properties being combined cannot be SSTBs. So those are your service incomes or your service trades or businesses like accountants, lawyers, doctors, etc. There has to be at least 50% common ownership between the businesses being combined, and they have to meet at least two of the following criteria. The products or services commonly are provided together, they share facilities or centralized business elements, or the businesses operate in coordination or reliant on each other. And this is disclosed on Form 8995A, which we'll look at here shortly, Schedule B. And I actually do have an example in here, just how it would look. So if you look at this, there's the taxpayer's name. You've got these two partnerships that they have, one of which has a pretty much good amount of income, but no wages or property. So if this taxpayer was subject to the limitations, they would get no deduction for this $50,000 right here. But by aggregating, they can take advantage of the wages and the property in this first partnership. And you can look and see there's a description here. There's under line 1, greater than 50% common ownership. The same widgets from partnerships 1 and 2 are commonly offered together. Partnerships 1 and 2 share the same facilities, and the two partnerships' operations are reliant on each other. So there's a description in there as to what requirements they meet in order to be aggregated. The final regulations also allow aggregation at the RPE level, that's relevant pass-through entity, which partnerships, S corps, subject to the same criteria as the individual level. Now, a couple of notes: if businesses are aggregated at the entity level, the entity must disclose to its owners on a K1 statement or schedule identifying each business that's aggregated and a description of each business, including the name and EIN of each entity, the QBI, the wages, UBIA, and other applicable items. So when the taxpayers get their K1s, there should be a statement attached that shows all of the different businesses that the entity aggregated. All right. The taxpayer cannot disaggregate any aggregation made at the entity level. So if you get a K1 and that partnership decided to aggregate, the taxpayer is bound by the aggregation. And they must attach the aggregation statement from the pass-through entity to their tax return. So a couple of notes on aggregation. One thing, strongly consider not aggregating at the RPE level as it restricts the ultimate taxpayer's options. I would say if you prepare the entity and the ultimate taxpayer tax returns, maybe you can go ahead and do that. But if you're providing K1s to non-clients, then I would suggest not doing it and give the taxpayer the option to aggregate or not at their level. And also don't blindly aggregate. There are circumstances where this is not beneficial. And I'm going to show an example here real quick on that. All right, so we have our second tenant's code word is qualified. I'll give you a second to type that in or write it down. Again, that is qualified. All right, so in our example here, we have F is a single taxpayer, owns 100% of X and Y. Both X and Y have $1 million of QBI. X has $400,000 of wages, and Y has $4 million of UBIA. If F elects to aggregate, the total QBI is $2 million, the combination of the two, 20% of which is $400,000. Since they're aggregating, they're taking the wages and the UBIA, finding the largest amount, which in this case, they're both equal to $200,000. So by aggregating, they're allowed to take a $200,000 deduction, which is great. However, if they choose not to aggregate and they calculate the deduction separately, because remember, each of these is calculated on an activity by activity basis unless you aggregate. X is limited to $200,000, again, which would be the 50% of wages. Y has a $200,000 QBI deduction limited to $100,000. The 2.5% of UBIA plus 25% of wages. So by not aggregating, the total deduction is $300,000. So just don't. The advice is make sure you're aggregating for a reason and not just for simplicity or because you just feel like you need to aggregate. There are instances where it's not beneficial, so please be aware of that. What's new for 2022 returns? Nothing really. The only thing that I indicated earlier that's different is the threshold for when the wage and limitations kick in, 326.6 and 163.3. So everything else has pretty much remained the same. Back in 2019, we got the new form 8995, as well as the 8995A, which is the more complex form with 4 additional schedules. 8995 is used if the taxable income is below the threshold. 8995A is used if it's over the threshold. That's generally the guidance right there. Of course, back in 2019, the proposed regs went out the door and only the final regs could be used. And we also got a safe harbor election for rental properties. Same as in 2019, 2020 will be the same. There's only one code on the K1s for 199A information. Everything you're going to need is in a statement further on through the K1. Back in 2018, there were different codes for each of the various items of QBI information. Now we only have the one. Now, one thing that did come into question several times last year, one thing that the final regs did specify is that the following items must be deducted at the taxpayer level to determine QBI. And the biggest one on here that everybody had an issue with was the self-employed health insurance, because this is already deducted at the entity level to get ordinary income. But then according to the regulations, it has to be deducted again at the taxpayer level. And there was an FAQ, frequently asked questions, released by the IRS, I think, about a year and a half ago. And on one of these questions, the answer was yes, the health insurance deduction is deducted twice to get your deduction. So just note that when your tax software reduces the amount of QBI by the SE health insurance, that is correct. Rentals, I'll spend a little time on rentals. They can be considered QBI if they rise to the level of trade or business. It's a facts and circumstances test. If you feel that it's a trade or business, then, and you can defend that position, then the deduction can be taken. Triple net lease is not considered trade or business and is therefore not eligible. That's the one exception. Renting tangible or intangible property to a commonly controlled business will be treated as QBI if the same person or group of persons owns 50% or more of both businesses and both entities are RPEs. C corporations do not count. Again, this is only available to partnership or pass-through entities and not C corporations. There was a safe harbor that came out a few years ago that allowed you to treat rental property as trade or business if it met certain criteria. Criteria was separate books and records are maintained for each rental property, 250 hours of rental services are performed each year, and contemporaneous records are kept showing the hours of services performed, the description, the dates, and who performed the services. So that election is out there. It is not eligible for property used as a residence for any part of the year, like vacation homes, not eligible for triple net lease property, not eligible for property rented to a business with common ownership, and it cannot be used for property where part is treated as an SSTB. So there are restrictions for the safe harbor. Statement needs to be attached to the return supplying the following information: the description of the property, as well as a representation that the requirements have been satisfied. I believe that they have dropped this, but the initial requirement was that it had to be signed. There's a statement that had to be signed that under penalty of perjury, the taxpayer certified everything was correct. I believe that has been dropped, but the statement still needs to be attached to the return. All right. I already briefly mentioned the 8995. 8995 is a simple form used when there's no threshold, no limitations. 8994 is used for all other instances. 8995A is used for your SSTBs. If the taxable income exceeds the threshold plus the phase out, there's no deduction, no 8995, no 8995A, no nothing for SSTBs. Schedule B, we looked at an example of that. That's for aggregations. Schedule C is where all the losses and carry forwards are going to get entered. And Schedule D is used for patrons of agriculture or horticultural cooperatives. I have not seen or used that form at all, or that schedule at all, but it is out there for any applicable businesses. So at this point, if there are no questions, I will give Kendra back, and she is going to go through Section 163J limitation.
All right. Can everybody see the screen for 163J limitations?
Yes.
Okay. All right. So our next topic today will be the business interest expense limitation. Major changes were made to 163J in the Tax Cuts and Jobs Act of 2017. So we've been dealing with this for a few years now. This year, additional changes were added and amended by the CARES Act. And we'll go over the basic provisions of this code section and some of these changes. Section 163J1 limits the amount of business interest that a taxpayer can deduct. It does not apply to certain small businesses whose average gross receipts are $25 million or less, electing real property trades or businesses, and certain regulated public utilities. For tax years beginning after December 31st, 2017, business interest expense deductions paid or accrued are limited to the sum of the taxpayer's business interest income, 30% of the taxpayer's adjusted taxable income, and the taxpayer's floor plan financing interest expense. This applies to any debt outstanding on January 1, 2018, including related party debt and debt with third parties. And it applies to all taxpayers and all debt used in a trade or business except capitalized interest. This is only a timing difference, as any disallowed business interest expense can be carried forward indefinitely. Under the CARES Act changes, the 30% of taxpayers' adjusted taxable income was increased to 50% for 2019 and 2020. And taxpayers can elect to use their 2019 adjusted taxable income in computing the 2020 limit, which will help taxpayers whose income declined in 2020. Changes also permitted taxpayers to elect to apply the more restrictive 30% of ATI limit. Partnerships can only apply the 50% change to the 2020 tax year. Now it's time for our third code word. It's holidays. So add that to your survey form. Holidays. Now let's review the calculation of adjusted taxable income. This is the taxable income for the year as if 163J does not apply, and then you add or subtract various items of income and expense to arrive at an amount similar to EBITDA. Those adjustments are items not properly allocable to a trade or business, business interest income, business interest expense, net operating loss deductions, deductions for qualified business income, and depreciation, amortization, and depletion. For years after 2021, depreciation, amortization, and depletion deductions are not taken into account, so ATI will closely resemble earnings before interest and taxes. There are some exemptions and exceptions that apply. The small business exemption applies to any taxpayer other than a tax shelter with less than $25 million in average annual gross receipts for the prior 3 taxable years. The gross receipts amount is adjusted annually for inflation, so it is $26 million for 2020. Aggregation rules apply when calculating gross receipts. There are a few accepted trades or businesses, such as the trade or business of providing services as an employee, electing real property businesses, electing farm businesses, and certain regulated utility businesses. A tax shelter, as defined by Section 448, is not exempt from 163J and other provisions of the Tax Cuts and Jobs Act. Section 461 defines tax shelters as any enterprise other than a C corporation, if at any time interest in such enterprise have been offered for sale and any offering required to be registered with any federal or state agency having the authority to regulate the offering of securities for sale. Any syndicate defined in Section 1256, such as a partnership or S corporation, if more than 35% of the losses of such entity during the taxable year are allocable to limited partners or limited entrepreneurs. And third, any tax shelter, which is an entity, investment plan, or arrangement whose significant purpose is the avoidance or evasion of federal income tax. So the syndicate scenario is the one we will run into most often and can have a major impact on real estate partnerships. Section 461 defines limited entrepreneur as any owner of a business that is not a limited partner, but that is not actively engaged in the operations or management of the business. So basically a passive investor in a partnership. Members of an LLC can possibly be deemed limited partners for this purpose as well. So receipts of commonly controlled businesses must be aggregated for Section 163J purposes. It's determined based on Section 448C and Section 414M and O, primarily the affiliated services group, rules, where businesses are providing services to one another, as well as 52A, controlled groups of corporations under 1563, and 52B covers multiple organizations, not just C corporations. So under Regulation Section 52-1, an organization includes sole proprietorships, partnerships, trusts, estates, or corporations. The receipts of any mixture of these organizations must be aggregated if they represent either a parent subsidiary group where there's direct ownership interest in one another, a brother-sister group, or a brother-sister combined group, which does require a multi-step process to determine when two or more businesses should be included in the aggregation. It gets pretty complicated, but the IRS recently provided FAQs regarding the aggregation rules on their website. So if you want to review the guidelines in more depth, you can go there and find more information on the aggregation rules. An election can be made by real property trades or businesses and farming businesses to avoid the interest expense limitations. A real property trade or business, as described in 469C7, includes 11 activities, such as real property development, redevelopment, construction, rental, operation, management, and leasing or brokerage businesses. The biggest effect of making these elections is on the application of the depreciation rules. In order to deduct interest expense in full, it must depreciate certain assets using the ADS method. Section 168K provides that you cannot claim 100% bonus depreciation on any asset depreciated using ADS method. Depreciable lives are different under ADS. For instance, non-residential 39-year property becomes 40-year property, and residential 27.5-year property becomes 30-year property. Qualified improvement property, which now has a 15-year life, would have a 20-year life under ADS. So the change in depreciation has to be made to all assets already in service. This change is not treated as a change in accounting method, but rather a change in use, and it does not require a Form 3115 to be filed. The election is irrevocable. However, under Revenue Procedure 2020-22, there are certain limited circumstances where it could be revoked. To make the election, you would attach an election statement to a timely filed original tax return, including extensions, and the statement must contain information for each electing trade or business to be included. If a partnership reports excess business interest expense to the partner is required to file Form 8990. A taxpayer may also have a Schedule C, E, or F that would require reporting on the 8990 if the average gross receipts from all activities were above the threshold. The Partnership Form 1065, Schedule K1, reports the following items if 163J applies. In box 13, they'll pass through other deductions. Code K, any excess business interest expense. And then if the partnership was required to file 8990, it may determine it has excess taxable income and or excess business interest income to pass through to the partners. This would be reported in boxes 20AE and 20AF and used in the individual's Form 8990 reporting. So both final regulations and proposed regulations were released on July 28, 2020. The final regulations were effective September 14th. Taxpayers may apply regulations early or may apply the proposed regulations from 2018, but either option must be consistently applied. The final regulations provided a narrowed definition of interest and excluded certain items such as commitment fees, debt issuance costs, and guaranteed payments for the use of capital. This narrower definition of interest means fewer items are subject to the deduction limit, so a larger business interest expense deduction may be allowed. The final regulations also expanded the anti-abuse rule and developed a new term, tentative taxable income. The 2020 proposed regulations provide guidance on issues not addressed in the final regulations, such as how the limitations apply to pass-through entities, how to apply these limitations to U.S. shareholders of controlled foreign corporations, and to foreign persons with effectively connected income. Notice 2020-59 was also issued and included a safe harbor for qualified residential living facilities, which applies retroactively to tax years beginning after 12/31/17 and allows these entities to be treated as electing real property businesses. With the CARES Act changes to 163J and the qualified improvement property, taxpayers may want to reevaluate either the previous real property trade or business election or their decision to not make the election on prior returns. Revenue Procedure 2020-22 was issued to allow for a late election or withdrawal of a previously filed election for tax years 2018, 2019, 2020. Amending returns to take advantage of QIP bonus depreciation would require a 3115 filing. The rules for 163J limitation are complicated, so the big takeaway is to be aware of the gross receipts threshold for the small business exception and the tax shelter rules when you have passive investors and losses coming through partnerships and S-corps. If you think you have a client who would be required to aggregate its business activities for this calculation, or you need to apply the new regulations, please see one of the partners in the tax department to assist you. Now I'll open it up to additional questions, and I see Jeff already has one. So Jeff's question is, if you make the 163J election, does the longer depreciation life apply to tangible personal property, 17-year, that is included with the real property investment? I believe it applies to all property, not just the residential rental and all of that. The ADS lives would go into play on everything. Any other questions?